Hey everyone, welcome back to Corporate Decoder, the place where we unravel corporate secrets and translate financial jargon into something that makes sense. Today, we're diving into Dillard's latest Proxy statement. It's not exactly a thriller novel, but trust me, there are some interesting clues about the future of this department store chain hidden within these pages. We're talking about family ties, executive pay, and who really controls the company. Stick around because you might be surprised by what we uncover. First off, this is a definitive proxy statement, meaning it's the final version Dillard's is sending out to its shareholders before their annual meeting. Think of it as the official playbook before the big game, giving everyone the details on who's up for election to the board and what proposals are on the table. The main event is the election of 15 directors. It's not just a popularity contest. Class A stockholders, those with a certain type of Dillard stock, get to pick 5 directors, while Class B stockholders choose 10. This two-class stock structure is common among family-run businesses to maintain control. Speaking of control, let's peek at who owns the most shares. Newport Trust Company holds a significant chunk of Class A stock, about 40%, but they're basically just holding it for the employees' 401k plan, so they don't get to actually vote it. WD Company, owned by the Dillard family, practically owns all of the Class B stock, giving them almost total control. Now let's see how much stock the executives own. William Dillard II, Alex Dillard, and Mike Dillard own a significant amount. What stands out though is how much Class B stock the WD company owns. It really underscores how tightly the family controls the company. Time to meet the nominees for the board. These are the people who will be steering the ship for the next year. Class A nominees are all independent, meaning they aren't current employees or closely tied to the company. The board recommends that each nominee be elected. One interesting Class A nominee is Rob Himes, the head of Texas Capital Bank Shares. Having someone with his banking experience on the board could be valuable for Dillard's financial strategy. Nick White is another Class A nominee. He has lots of retail knowledge because he used to be an executive at Walmart. On the Class B side, you've got Alex Dillard, the president, who has been with the company for over 50 years. That kind of experience is hard to replace. Warren Stevens of Stevens Inc., another Class B nominee, brings financial expertise, which is always useful in these uncertain economic times. It is stated that the board has determined that all of the Class A nominees qualify as independent. This is important for corporate governance as it ensures that some members of the board are not beholden to management. Here's a noteworthy detail. There is a policy against hedging company stock. It's a rule that stops directors and employees from using financial tricks to avoid losing money if Dillard's stock price goes down. This means they are more invested in the long-term success of the company. How much are the directors getting paid? Non-employee directors got a cash retainer of $100,000 plus some stock. Serving on the audit or compensation committee also gets you an extra $30,000. Now for the juiciest part, executive compensation. This section explains how the top executives are paid and why. It's designed to align their interests with the company's performance and reward them for a job well done. At least that's the idea. The main components of executive compensation are base salary, annual cash bonuses tied to the company's income, stock bonuses, and pension benefits. These are pretty standard tools for rewarding executives. The cash bonus is limited to an amount calculated according to a formula, and the annual stock bonus is also calculated according to a formula. Here is a breakdown of how the total pay is divided up for each executive. William Dillard II, the CEO, and Alex Dillard, the president, get more of their pay tied to performance than other executives. So for our CEO, around 63% of the pay is based on achieving some kind of profit. Equity-based compensation is only 5.8%, Koiken and Dillard. The executive vice president gets 50% of his total pay based on performance. 4. Those interested, all the values are available in that table. How does Dillard's decide how much to pay its executives? They compare themselves to a peer group of other retailers like Abercrombie and Fitch, American Eagle, and Nordstrom. But Dillard's also says its executives have more responsibility than their counterparts at these other companies, justifying higher pay. Executives get stock bonuses equal to 6% of their annual pay above $15,000. This incentivizes executives to make decisions that will increase the price of the stock. Something to keep an eye on is that the company may not be able to deduct all of the compensation it pays its executives for tax purposes. There are limits on how much a company can deduct for pay to certain executives. The compensation committee says it has reviewed and discussed all of this with management and they think it's all fair. This is where we see the actual numbers for what the executives made. William Dillard II, the CEO, took home about $4.8 million in total compensation, but almost nothing in options. Drew Matheny, Executive Vice President, got about $3.2 million. The pension benefits are also pretty hefty. That William Dillard II's pension plan is worth $38 million. This section details what happens if an executive leaves the company or if there's a change in control. A change in control is basically another company buying Dillard's. If that happens, the executives could get big payouts, especially from their pension plans. For example, William Dillard II could be entitled to almost $55 million. The CEO pay ratio is a comparison of how much the CEO makes compared to the median employee. At Dillard's, the CEO makes 132 times what the median employee makes. There is a section that compares executive pay to the company's performance. It basically shows how closely executive compensation is aligned with the company's financial results. Moving on, the next proposal is about ratifying KPMG as the company's independent auditor. It's basically a vote of confidence in the company's accounting firm. The fees paid to KPMG totaled over $1.7 million for audits and other services. It looks like some executives filed some ownership reports late. There were a few late filings, but nothing too major, just routine transactions. Here are some interesting details. Stevens Insurance, owned by director Warren Stevens, received over $1 million in commissions from selling insurance to Dillard's employees. Also, Dillard's paid the Connor Group, run by director William Connor, over $3 million for agent fees. These related party transactions are not uncommon, but it's important to take note. So what's the big picture here? Dillard's is a company with strong family leadership, and that control is reflected in many aspects of the business, from the board to the vendors it uses. Dillard's seems to be in a stable position, though its future depends a lot on consumer behavior and how well they manage their inventory and supply chains. There is a high level of insider ownership, however, that is not necessarily a guarantee that company performance is aligned with shareholder success, as long as family members are able to receive these large benefits. It depends on the family itself if its intentions are aligned. Thanks for watching. If you found this analysis helpful, be sure to like, comment, and subscribe for more deep dives into the world of corporate filings. What company would you like to see decoded next? Let me know in the comments below.